Welcome. We are discussing about financial management, and my name is Krishnamurthy Bindumadhavan. In this particular segment, we will be talking about risk management. And actually, within risk management, there will be three segments. And in this first segment, we will be looking at the various calculations that are involved in risk management. So, how to calculate the average or mean return, and how to calculate or quantify the variability in the returns, because the variability in returns is what we call as risk. And so we want to understand first the definition of risk and the calculations around that. So how to do the actual calculations. Given a set of returns for a particular stock, then how do we calculate the risk, the underlying risk, which is captured through the variability in the returns. And you all have taken a quant class, so you understand basic statistics. That is my assumption, right? So if you are a little bit weak on that front, then you should revise some of the basic calculations, like how to calculate an arithmetic mean, right? How to calculate standard deviation. I will be doing that, but it may be helpful to revise that a little bit in case you are a bit shaky with regards to the basic statistics. We will look at the applications of those concepts, and while doing that, I will also be explaining those concepts. So you should be in good shape. But if you feel that you are really weak, you might want to review the basic statistics part. Okay, that is the descriptive statistics. And also probability statistics. We will be getting into some elements of probability statistics as well in this segment and in the next segment. So we will see how to quantify risk and what is meant by risk attitudes, and then we will slowly get into portfolio diversification. Portfolio diversification is a concept that was advocated by Markowitz in the 1950s, late 1950s or so, where he came up with the idea that we can actually diversify away the risk. That means we can minimize the risk if you have multiple assets in your portfolio wherein the assets are not correlated with each other. And so coming out of that portfolio diversification concept is one of the cornerstones of finance, a theory or a model called the CAPM model. CAPM stands for Capital Asset Pricing Model, CAPM or CAPM model, and we will be discussing that as well. So here's what we have. Initially, we will talk a little bit about how to calculate return, what is meant by return and how to calculate return. We'll also look at geometric mean and arithmetic mean of the returns, because if you are having returns, so first thing is, let's say we are having a particular stock. Okay, let's say Tata Motors is of interest to us, suppose. Then we can go to the NSE website, for example, and then we can download the data for this particular stock. Let's say we do that for the last 3 months. Okay, so from let's say from 1st June, then end of June, end of July, end of August. Let's say till 30th of August, we download the data. This is nothing but the price of that particular stock. So, which, as you know, in the stock market, it is varying, right? So the strike price will be going up and down, something like that. Then from this price, so price is of course varying on a constant basis. So what we will look at would be the closing price typically for analysis purposes. So at the end of the day, what was the closing price? So from that, we will calculate the return. And we will see how to do that in just a minute. So that is the first thing actually that we are going to look at, how to calculate the return. But once we have calculated the return, we will have, let's say, about 60 data points or so. Because 3 months means usually about 20-22 days, working days are there in a month. And so we will have about 60 data points or so, right? Calendar days are 30, but actual working days would be about 20-22 in a month. So around 60 data points will be there. So from this we can calculate the different types of averages. So One is of course the familiar arithmetic mean, that is the average or the arithmetic average, which everybody knows. You simply add them and then divide by the number of items. So that is a simple calculation. Then there is the geometric mean. We will see a little bit about how to calculate that as well. And then we will get into the definition of risk. How do we define risk? See, when you look at the stock market, like the diagram that I have put here, or actually the better way to represent that would be something like this. You know, it's constantly moving like that, up and down. So this variability that we are seeing, right, that quantification of that variability is what we refer to as risk. Okay. So how do we define that? How do we quantify that? And how do we calculate? So all those calculations we are going to look at. So this is going to be a quant intensive segment. So you will need to be prepared for that, and you will need Excel and potentially your calculator as well, right? So I won't go into the nitty-gritties of the calculations using the calculator, but I will be providing a few slides which will give you some guidance on that. Okay, and if you have questions on that, we can discuss it maybe on the Takshila forum and also through offline methods, maybe through email. You are welcome to communicate to me. Okay, but if significant number of students indicate that they have purchased the Texas Instruments BA2 Plus calculator, then I am willing to even maybe spend half an hour in one of the live classes talking a little bit more about how to use the calculator or to familiarize with you with the calculator. But that depends on the response of the students. So if you are all going to purchase, or say majority of the students are going to purchase the calculator, then it might be time well spent. Otherwise, there are other resources which the students can leverage. So anyway, but calculation is important because that is the nature of this game, right? This is finance, and within finance we are talking about a particular area which is really calculation intensive. Even the previous segment, time value of money, there were a number of calculations involved. And the previous segment before that, which is financial statements analysis, where we discussed about horizontal analysis, vertical analysis, ratio analysis, DuPont analysis, again that was calculation intensive. So finance, there will be a number of calculations, and I am giving you advance notice that you should practice these calculations. So don't walk into the mid-semester exam thinking that you can sort of, do the calculations on the fly. That is not going to happen. I mean, if you're going to do that, then, you can be sure, or I will be sure of what results you will get, right? So it is better that you practice and put in significant effort to practice and also become familiar with the calculator so that you can do well in the exam. I mean, studies and learning is much more than the exams, but I'm just giving you an idea because students, being students, you will also think about the exams. So that's why I'm giving you advance notice that practice is very important. In the class, when I am working with data in Excel, or when I do some calculations using the calculator, or however I do it, it might all look very simple and straightforward. Because it has to, as I have said earlier, that's my job, right? I have been doing this for more than 15 years. So I know these calculations in and out. And what we are studying is actually things that we do in the industry. So therefore, having spent more than 15 years in the industry, I should know how to do these calculations, and I know them like the back of my hand, as they call it, or the palm of my hand, however you want to think about it. So, but for you, maybe you come from different backgrounds. Some of you might have a finance background, but even then I encourage you to practice. But needless to say, people without the finance background, without a quantitative background, should definitely plan to spend a good bit of time practicing using the calculator and using maybe Excel as well. Okay, so but practice makes you perfect, and that is really important in finance, and particularly in several of the things that we are going to discuss and we have discussed in the past, and we are going to discuss now and in the succeeding weeks as well. So very important. I can't overemphasize the value of practice. Then After these calculations, we will talk about the relationship between risk and return. I have alluded to this before as well, that if there is less risk, the return will be lower. As we take more and more risk, the return should be higher. Risk and return go together. That is a very fundamental concept in finance. The higher the risk you take, the higher the return that you will get. And you can see that in practice as well, if empirically. So if you look at the outside world, for example, right, bank deposits, that is lower risk, and then bonds, a little bit higher risk, stock market, a little bit higher risk, derivatives, even higher risk, and we see that the returns are commensurate with the risk. Bank deposits will probably earn you about 8% or so. Bonds, that is corporate bonds, may earn you about 12%. Stock market may earn you 15 to 20%. And derivatives, depending on what kind of bets, etc. we are making, may earn you significantly more than 20%, right? So that is sort of the empirical evidence as well that we see in terms of the relationship between risk and return, and we'll explore that a little bit more. I have mentioned, we have talked about bank deposits as sort of the almost risk-free, but the true benchmark for risk-free return is actually the government debt. The reason is that government can always pay, right? Can always pay the principal or the interest component on debt denominated in domestic currency, whatever be the situation. Why is that? Why is it that the government can always pay back the debt? What special powers does the government have? And this is something that you may have already studied in economics, but it is important that we recall the point here. And there are two unique powers with the government which enables them to always meet their upcoming obligations as far as domestic debt is concerned. One is the fact that the government can increase the taxes, right? So the government has the taxation power, the power to tax its citizens, and if required, let's say that a series of government debt is coming due next month, and there is a shortage of funds in the government treasury, then the government can always increase the tax rates. It could say, okay, we are going to increase the income tax rate, or we are going to increase some other service tax rate, or whatever it is, and by increasing the taxes, they can generate additional revenue so that they can meet their upcoming obligations. Of course, if it is an election year, then that's a different story, because if the government increases taxes, then they'll be thrown out of the office, possibly, right? So politicians, being politicians, they are very shrewd, so they will not increase the taxes if it is election time. What can they do then? Well, they can get the printing press to work, right? As simple as that. So if 10,000 crores of debt is coming due next year, and it is going to be an election year, let's say, then instead of raising taxes, the government will get the printing press at all the various mints located across the country, right? Right here where I'm sitting in Hyderabad, we have a mint, and the RBI controls these various mints where the currencies are printed. These are high security facilities where they print the currency, and they will simply print 10,000 crores. And once the investor comes back and says, okay, can I retrieve my funds for the Kisan Vikas Path or whatever Yojana that they have, then the government will say, fine enough, and they will give you the newly printed currency, isn't it? So the government can either increase taxes to generate more revenue, or they can print currencies. They can print new currency. And so therefore, debt, government debt denominated in local currency, that means Indian government debt denominated in Indian rupees, US government debt denominated in US dollars, and so on, are considered to be risk-free. That is the benchmark for risk-free return, for the reasons that I just mentioned. Bank deposits, particularly bank deposits with public sector banks in India, are also close to risk-free. Very rarely, and actually there is no incident of the government letting down the banking system. The reason being, the banking system, if there is a shock in the banking system, it can have a ripple effect on the entire economy, and that can have disastrous consequences for the country. So therefore, generally speaking, the government will bail out the banks or the banking system. And in fact, there is something called as a deposit insurance scheme. Okay, so in the US, there is something known as the FDIC, Federal Depository Insurance Corporation, which takes care of retail investors. The banks contribute some kind of a premium, and so if a bank gets into difficulty or is about to fail, then the FDIC will come in and pump the money so that the deposits are safe, the retail deposits are safe. Because if customers start panicking and start withdrawing money, then the confidence in that particular bank will go down, and not only that particular bank, there will be a ripple effect in the entire banking system, and this confidence of the public in the banking system may erode, which will obviously have a ripple effect on the economy, and that is going to be disastrous. So therefore, the government will usually support the banks and the banking system. So bank deposits can also be considered close to risk-free, but the benchmark for risk-free, as I mentioned, is the Treasury returns. And in the United States, there is something known as US Treasury, and that is similar to the Ministry of Finance in India, and they issue the government debt. So they will issue short-term debt, which is called as Treasury bills, medium-term debt, which is called as Treasury notes, and long-term debt, which is known as Treasury bonds. And these are all considered to be risk-free. Similarly, there are other government-issued long-term debt that is also referred to as GILT. GILT means government-issued long-term debt. And those are considered as benchmark reference rates, risk-free reference rates worldwide, right? So after that comes the other risky instruments, and we will see that the risk and return are highly correlated. So the higher the risk, the more the return. So we will explore that further in little later in this class. And then we will also talk about probability distributions, that is continuous versus discrete distributions, and because the calculations were slightly different, right? So calculating the mean, calculating the standard deviation, which is a measure of risk, is slightly different for continuous distribution versus discrete distribution, and we will take a look at that as well. Then we'll talk about risk attitudes, right? Some people, are really willing and able to take on a lot of risk. If you see, not everybody is interested in investing in the stock market, although we know that we may get a higher return in the stock market, but we also know that there is more risk. We also know that there is more risk. So therefore, some people will be hesitant, right? There are conservative people, and then there are more aggressive investors who are willing to put their entire savings into the stock market. But others may be a little bit hesitant. They may put some of their money in the stock market and the rest of the money may be in deposits. And then at the other extreme, there are people who will only put their money in bank deposits, right? You would have seen that. There are people, even for example, there are many people in my profession who are finance professionals, but when it comes to their own personal investments, they may not be willing to take the risk. That is dependent on your psychological makeup, which is shaped in turn by a number of different factors. Just because you have got a PhD in finance does not mean that you will go out and take the risk. You might advise, right? As a consultant, you might act as a consultant and advise other people to invest their money in the stock market, but are you willing to put your money down? That's a different ball game altogether. It depends on your attitude towards risk, and that is a very important consideration, and we will discuss that as well. Then we will talk about portfolio diversification, and we'll talk about the concept of systematic and unsystematic risk. The idea here is that if we add more and more assets to the portfolio, we will be able to reduce the risk. But even if we add all the assets in the world, still some risk will be left. And that is what we refer to as systematic risk, and we'll talk about that. And then, as I mentioned, lastly, we will talk about the CAPM model, which is a cornerstone in finance, that is capital asset pricing model. So this is the agenda that we have, and I will be covering this in three segments, okay, in three parts. This first segment I will be covering in three parts, and then we will have another two segments as well within the risk management framework. Okay, so risk management, very, very important concept in finance, because ultimately, we want to ensure that we are able to optimize the returns. And since risk and return go together, we have to manage risk in order to be able to optimize our returns. As I have mentioned earlier, there is a lot of material here, and the challenge is to ensure that you get a good exposure to all the key concepts without really sort of getting bogged down with the details. And that's what we are going to do. We are going to get a good understanding, good overview of the concepts, and we'll take a deep dive in certain important concepts, right? But there is still a whole lot to explore, and clearly, we can't achieve everything within the framework or within the sort of boundaries of a program or a class like financial management, which is an introductory finance course. But nonetheless, I will endeavor to give you a good introduction and a good foundation in finance, but you will have to work with me. As I said, the calculations are important and you will have to put in your effort to do the calculation. So we start with the basic calculation, how to calculate returns. So if we make an investment, let us say we are buying a particular stock or an index, right? Index means a bunch of stocks combined together, how they move, they are tracked, right? For example, the Nifty. So the Nifty is an index that is maintained or managed by the NSE, the National Stock Exchange. And there are different types of Nifty indices. We have a Nifty 50, we have Nifty 100, Nifty 200, a banking Nifty, banking sector Nifty, and so on. So there are different types of indices out there depending on the needs of the investors. And so there are ways for us to invest in the index. How can we invest in the index? Well, there are mutual funds which will track those indices, and so they will take your investment and they will allocate it in the makeup, based on the makeup of the index. So the Nifty 50, for example, consists of 50 different stocks. So if you invest in a mutual fund which is tracking the Nifty 50, what they will do is they will take your 10,000 rupees and then they will invest in those 50 stocks, right, in a proportionate manner, so that you are able to get the returns of the index. So whatever the index does, they are going to try and mimic. The index might do something like that. It might go up, it might come down, and our investment will also track that. Obviously, as a retail investor, it will be very difficult to invest our money in 50 different stocks, because some of those stocks may themselves cost, say, 2,000, 3,000, even 5,000 rupees. So if you have only 10,000 rupees, then it may not be possible to invest or split your investment across 50 stocks. That's where the mutual fund comes in. What they do is they raise money from hundreds of thousands of investors. So you invest 10,000, right, and Ram there invests another 10,000, right? John Crenshaw invests 10,000, and someone else XYZ invests 10,000. So all these hundreds of thousands of investors pour in money, and you end up with a huge kitty, maybe crores of rupees. If you look at Reliance, they are managing thousands and thousands and thousands of crores of rupees. I have lost count of it. You can check in the newspaper maybe, and you will see how many thousands of crores is being managed by the Reliance Mutual Fund. So when they have such a huge kitty, it's not a huge problem for them. It's no problem at all for them to split it up and invest in these 50 stocks, so that they can track the Nifty index, and that's what they do. So, but anyway, coming back, how do we calculate the returns? Well, what we will do is we will get the data. So we will get the price data by date, right? So we have different dates. As I said, maybe for 3 months, let's say, we download the data for the Nifty 50 or for Tata Motors or whatever stock that is of interest to you. And then what do? We take, suppose we want to find the return, then we will open another column for return. And we will take PT, that means if you are looking at this point, the second point, that is we will take this price and then we will subtract the previous day's price and then divide by the previous day's price. Okay, so we take today's price, subtract yesterday's price and divide by today's price. That gives us the capital appreciation part of it. This is the capital appreciation part of it. Capital gains, right? In a particular day, how much did the stock move? It might have gone up like this, or it might have come down right? So if it has gone up, then you will get a positive return. So if it is going up, it will be a positive return. If it has come down, then you will get a negative return, right? I don't think you should have any difficulty so far in following what I have said. So all we do is we take today's return, subtract yesterday's return, and divide by yesterday's return to get the capital gains component of it. And what is this DT? That speaks to the dividends, right? So is the company giving you any income? Dividends are nothing but income that is coming back to you from the company in which you have invested. So we need to take care of that as well. We need to take account of that when we are calculating the total return. So we are adding the dividend to the increase or decrease in stock price and dividing it by yesterday's stock price to find what is known as the simple return. This is called simple returns. Right? I have defined that in words over here, so you can read through that, but I have explained this concept. Right? So this is how we will calculate the return. Let's look at a simple example. Suppose there is a stock, and let's say the price of that stock was $10 per share 1 year ago, and let's say it is currently trading at $9.50. That means the price has come down, right? So therefore you can expect a negative return. But then there was also a dividend paid of $1. So then what was the return earned over the past year? That is the question. Okay, what is the return earned over the past year? So how do we calculate it? What I request you to do is to pause the video, and then you know the formula. I have already mentioned it. So the return is calculated in two parts, right? We have the dividend that has been paid, and then the change in the price. So what is the price today minus the price yesterday divided by the price yesterday? That will give us the return. So pause the video and do the calculation because all the inputs have been given. Now assuming you have done that, let me share with you the answer. So we know that the dividends paid were $1, and we know that the price today is $9.50. We know the price yesterday, or rather 1 year ago, was $10. And so we take the $1, which is the dividend or income. That is the income that we get from the stock. And then to that we add the capital gains. Unfortunately, in this case, it is not a capital gain, but it's a loss of 50 cents over the past 1 year. But whatever it is, whether it's a gain or a loss, we need to add that to the income. And then we divide it by the price at the start, which was $10, right? $10 last year. And so we get our 5%. So this is how we would calculate the returns. Before we move on to the average, and there are two types of averages, that is the geometric and arithmetic average. I want to show you how to download the information from the NSE website, or maybe similarly from Money Control, etc., Yahoo Finance, right? So you can download for a real stock. Here we have looked at a hypothetical stock, stock A we have said. But let's do this for a real stock, and you can download it from NSE index. I'm going to show you NSE, but if you could also get this data from Money Control, which I have shared with you. That's another website, or maybe from Yahoo Finance, and there are other websites as well. Okay, so I won't go into the details of each and every website, but I think this is plenty. And NSE itself is a gold mine, right? Not to speak of Money Control or Yahoo Finance. And there are other websites also which you can explore by Googling. So what we will do now is we will go to the NSE website and we will download Tata Motors closing price for a 3-month period, and then we will calculate the return on that, right? And then we will see how to calculate the average. That is, we will see how to calculate the arithmetic average and the geometric average. Before we do the actual average calculations, we will revisit this slide. But first, let us see how to do the return calculations. So here we go. So I'm going to go to Internet Explorer, right? I've actually already done it, but then I'm going to show you how to do it once. So we will go to Google, which is my favorite starting point. Then I simply put NSE. So then it takes me to the NSE website. So once you are in NSE website, then you can enter the symbol of the company that you're interested in. So let's say we are looking at Tata Motors, then the symbol for Tata Motors is actually Tata Motors. So you just type Tata Motors here, and so if you click Tata Motors, then it will give you the details for Tata Motors, right? So here we have a snapshot picture of Tata Motors, what is going on with Tata Motors. So you can actually then download the data. So you can go to the historical data. So here you can see, you can go to products. Let me see if I can increase the font. Yeah. So you can see the link here, how I have gone. From home, you go to products. From products to equities, that is here, right, in equities. And then from equities to historical data. So you can go to historical data under equities. And then you can go to security wise. So you can go home, products, equities, and then historical data, and then security wise price, volume, information, or archives. So from there, I have entered the Tata Motors again, and then I have said for the past 3 months, and so then it has given me this data set here, right? This data set which relates to the past 3 months data of Tata Motors from the NSE website. Then you can download this. There's a link here which says download file in CSV format, right? CSV stands for comma separated values. That is compatible with Excel. So if you click that, then the file will get downloaded, which is what I have done. And so then now I'm going to go to my Excel, right? So is it clear? All you have to do is to go to NSE. Go to NSE website, which you can do by doing a simple Google search. And then from NSE website, from products, you can go to equities, right? And then from equities, you can go, as I have shown here, through from equities to historical data to security wise price volume archives, and then you can enter the symbol for the particular company that you're interested in, or even the indice. And first, of course, you have to select what type of data you want, and there are a few different choices. I have selected price volume data because for our purposes, that is what we are interested in. For most purposes, as far as this course is concerned, we are only interested in the price data. But price and volume is a bundle, it's a package. So we will download both, right? For our purposes, we are not as much interested in the volume, and we are not interested definitely in the other things like the deliverable positions data, etc. That could be of interest for different types of analysis, for other types of analysis, which we are not going to go into in this particular course, right? All you have to do is essentially get here and then select security wise price volume data, enter your particular symbol, and if you're not sure of the symbol, you can do a Google search for that symbol, and then you can select the series that you're interested in, or just say all, and then all is the best thing to do there, and then enter how many months of data you want, and or you can give a time period here, right? And then click get data, and it will list this data, and you can click the download file, which will then download the file into an Excel file. So let's go to that Excel file. So here I have the data downloaded in Excel, and as you can see, this is for Tata Motors. I just downloaded this, and we are having the data from the 21st of August till 18th of November, right? So I have done the most recent 3 months of data I have downloaded. There are about 60 data points or so, 59 data points. That depends on the number of working days or trading days, right? So due to bank holidays and other public holidays, and the exchange might also be closed on certain days. So therefore, the actual working days would be less than the number of calendar days. So anyway, we have this data. Now what we want to do is we want to calculate the return. Now what we have seen in that particular slide is called as the simple return. So how do we calculate the simple return? We take the yesterday's price and we take today's price, and then we subtract yesterday's price and then divide it by the yesterday's price, isn't it? So we have a starting point, and then from the starting point to the ending point, how did we get? That's what we are interested in. We are taking today's price, subtracting yesterday's price, and then dividing it by yesterday's price. So that gives us the return. And so similarly, we are going to calculate the return for all the months. All I have to do is double click it. So if I double click it, then we get the returns for the entire set of 60 data points. Okay. So here I have ignored the dividends. So you can also get the dividend data and include that. But for this purpose, just to illustrate, I have ignored dividends. Okay. So if the company is a regular sort of dividend issuing company, if it is a company that regularly issues dividends, then you might want to actually capture the dividend information as well. Okay, so I have ignored the dividends in this particular calculation of returns. And there is something called log return, which is also another useful metric. And the reason this is useful is because in finance, a lot of the calculations that we do will be based on this log return due to the unique properties that it has. Okay, and those are a little bit advanced, so I won't go into necessarily into the details of that, but I just wanted to share with you. For our purposes, we will only use simple returns, but just wanted you to understand that there is something called log return as well, and I will show you what that is. That is not very complicated. It is nothing but the logarithm. You can see this ln stands for logarithm, natural logarithm, that is to the base of e of today's price divided by yesterday's price. That is called as the log return, and here are the log returns. And you can see that the simple return and log return are not very different, but there is a slight difference. And if you recollect, in our time value of money, we talked about discrete compounding and continuous compounding. Simple returns are under the assumption of discrete compounding, and log returns assume continuous compounding. Okay, so that's the difference between the two. And because of the way the modeling is done, for example, option pricing models, and the benchmark there is the Black-Scholes option pricing model, that assumes that the returns are continually compounded. So therefore, log returns are the correct type of returns that we should use when we are using such models. So therefore, in finance, we use log returns extensively. We also use simple returns, and for the purposes of this class, we will only be focusing on simple returns. But I wanted you to be aware of the concept of log return. Okay, so what have I done? I went to the NSE website, and then I downloaded the last 3 months data, price volume data for Tata Motors. Right now, actually, let us step back and take a look at this data so that you may not be familiar with it. So let's take a quick look at the data. The data is broken out into various columns. First, we have the symbol, and of course, we have downloaded only Tata Motors data. Then the date, right? The series, okay, that we will ignore for now. That is not so important. Then the date when the transactions happened. Previous close, open price, high price, low price, last price, closing price. These are the price data points that we have. We have closing price, we have last price, we have low price, we have high price, we have open price and previous close. 6 data points are there, but we will only use the closing price. This closing price is the only thing that is of interest to us when we are doing calculations relating to the simple return. Okay, so we are interested only in the closing price. Of course, there is other information here. There is average price, then the total traded quantity, right? Turnover in lakhs and number of trades. These are the other columns here. You can download this from NSE website for Tata Motors or for another company of interest to you, and then try to recreate this calculation. It is, as the name suggests, it is simple return, and it is indeed simple to do the calculation. So please try and do that for a company of interest to you. Okay, so this is the first step. Next, what we are going to do is we are going to calculate the geometric mean and arithmetic mean. But before that, let's go back and take a look at the definition of geometric mean and arithmetic mean. What do we mean by geometric mean and arithmetic mean? So geometric mean, and hopefully this is something that you might have studied in your statistics class, right? And indeed you would have studied it in school, probably in high school or maybe middle school, somewhere between 7th, 8th, 9th and 10th standards. This topic would have been covered, right? And again, as part of the MBA program, we have a quantitative methods course, and I'm sure we would have covered this in that course. But we are going to do a quick review of that, and we will see how to apply that. within the context of finance. And there are two commonly used ways to calculate the average return, the arithmetic mean and geometric mean. There are other ways also, such as the harmonic mean, but we won't go into that in this particular class. Okay. So the arithmetic mean is the average that we are all used to, right? So all we do is we add up the number of items, and then we add up each of the items and then divide by the number of items. So for example, if I have three students, suppose I have three students in my class, and let's say one student got 80%, another student got 90%, and a third student got 100%, suppose. This is hypothetical, right? We can give 100% in a hypothetical case. So let's say we have three students and they scored 80, 90 and 100. What is the average? Well, all you do is you add 80 to 90, that is 170, and then you add 100 to that, so that becomes 270, and you divide by the number of students, which is 3, so 270 divided by 3 is equal to 90%. So the simple average of this, right, what we call as the arithmetic mean is nothing but a simple average, and the arithmetic mean here is equal to 90% for the reason, the way I just mentioned. We add 80 to 90, 80 plus 90 plus 100, that is 270, divide by 3, that gives us 90%. Okay, so the arithmetic mean is very straightforward to calculate. How do we calculate the geometric mean? The geometric mean is defined as the nth root of the product of n numbers. That's the definition. Okay, geometric mean is defined as the nth root of the product of n numbers. In other words, if you have x1, x2, x3 to xn, we multiply them and then we take the nth root of them. So if you take the nth root of that, that is called the geometric mean. So the geometric mean is simply the nth root of the product of the n numbers that are of interest to us. Okay, so that is how we calculate the geometric mean. How do we calculate the arithmetic mean? The arithmetic mean, we have already done that. We simply take x1, we add x2, and we keep on adding xn, right? We keep on adding them and then divide by n, which is what we did here to get the 90%. The arithmetic mean may not always capture the true rate of return. So therefore, especially when we are looking at compounding over a period of time, when we are looking at an investment over a period of time, then the arithmetic mean will not give us the complete picture, will not give us the correct answer. And so in such situations, we will have to fall back on the geometric mean. So in those situations, we will leverage the geometric mean. Okay, so both these quantities, that is arithmetic mean and geometric mean, are relevant and important in finance. The geometric average answers the question, what was the growth rate? That is, if you want to calculate something like the CAGR, which is a term that is thrown about, right? Which is a term that is thrown around extensively in say management circles, leadership circles. If you look at the financial reports of companies, you will see this term CAGR, compound average growth rate, right? So if you are looking at the growth rate for your investment and things like that, then the geometric average is the better metric to look at. The arithmetic average, on the other hand, that's also very useful, and that will help us to understand what is the average of the yearly rates of return and things like that. And the average is to some extent a predictor of the future. So therefore, we will use this for estimating what may be the expected return next year and things like that. We will use the arithmetic mean. So if you are looking at returns over a period of time and we want to get what is the growth rate in the returns, then we will look at geometric means. And if you want to find out what may be the expected return next year, then for that we will look at the average over a period of time, and in that case we will use the arithmetic mean or the arithmetic average. So that's the definition. Now there is actually one small caveat or one small adjustment that we need to make when we are calculating the geometric mean in the field of finance. The reason is the returns can also be negative. How did we define geometric mean? So the way we define the geometric mean is that it is nothing but the nth root of the product of n numbers. So suppose we have x1, x2, x3 and xn. All we need to do is multiply those n numbers and then take the nth root. Of course, n could be anything. So for our purposes, to keep it simple, we will assume two numbers, right? Let's say we are talking about returns over 2 years or something like that. 2 months, 2 years, 2 days, whatever it is. One return, let's say, is positive, and let's say another return is negative. Then how did we define geometric mean? We have to take the product of the two numbers and then we have to take the nth root. If there are two numbers, we will multiply the two numbers and take the square root. Because there are only two numbers, we will take the nth root, means the square root. So if one number is positive and another number is negative, then what happens to the product of the two numbers? So if x1 is positive and x2 is negative, right? You can give something to it. Let's say this is 10% and let's say this is minus 5%. Then what happens? If you multiply these two numbers, we will end up, when you multiply a positive number, if you multiply with a negative number, then what happens? We will end up with a negative number. Okay, so we will get a negative number. Now this negative number, can we actually find the square root of a negative number? Think back to your school days. Can we find the square root of a negative number? Is the square root of a negative number defined? We will have to go into what is known as imaginary numbers to find the square root of a negative number. The square root of a negative number is not within the range of real numbers. We have to go into imaginary numbers. And of course, we are dealing with finance. We can't imagine stuff. We have to be within the boundaries of the real number system. So we have to find a way out of this. And so therefore, since some returns can be negative, and since we can't find the square root or the even root of a negative number, we make a slight adjustment. And what we do is, instead of looking at the return, we look at the multiple. Okay, so let's give a concrete example so that you can understand what we are discussing here. Suppose, let us say we are looking at a 2-year period, and suppose we start with $100, that becomes, let's say, $200, and then becomes $300. Then our return in the first period would be what? 200 minus 100, right, divided by 100. So that's how we define the return. 200 minus 100 divided by 100. So that will give us 100% returns. You can check it. And then return in the second period is 300 minus 200 divided by 200. That will be 50%. So we have 50% return. Now, of course, here both the numbers are positive, but the methodology, whether we have positive number, negative number, or two positive numbers, the methodology is the same. What we are going to do is, instead of taking the returns directly, we are going to look at multiples. So I'm going to define what is meant by a multiple. Multiple means how much my money has become. That is called the multiple. So how much has it become? My starting money was 100. If it has become 200, that means it is multiplied by 2. If my starting was 200, it has become 300. That means it is multiplied by 1.5. Now this 2 that we have, the multiple for the first period is 2. And the multiple for the second period is 1.5. This I can write as 1 plus 1, and this also I can write as 1 plus 0.5. This 0.5 is our return. This 1 is our return. And this other one here refers to the principal. So the multiple is capturing not only the return, but also the original principal. Okay, my 100 has become 200 means my 100 of principal is there and another 100 of return is there. My 200 has become 300 means I still have my 200 principal and an additional $100 return, right? So therefore, the multiple captures the principal as well as the return. Now, how is this better than looking at the returns alone? Remember, the problem with returns is that the return can go negative. because my $300 might actually completely vanish. The stock might become a penny stock. It might become zero, right? Potentially. So if it becomes zero, then I have lost my entire investment and my return would be negative 100%. So therefore, it is possible to have a negative return, and we know the problem. If you have a negative return one period, a positive return another period, then the product becomes negative and we can't find the square root of that. So therefore, we can't find the geometric mean. So we are trying to find an alternative way of addressing this issue. And what I have said is that if instead of looking at returns, we look at multiples, then we can solve this problem. How so? Well, suppose we lose our entire investment. Suppose instead of the 200 becoming 300, it becomes 0. Can it become negative? It cannot. It can maximum, there is a lower bound which is 0. So if it becomes 0, what happens? That means that I have got 0 multiple, right? My return is minus 100%. My return is minus 100% if it becomes 0, but my multiple is 0. Why? Because I have lost my principal as well, right? So the return may go negative, but the multiple will never go negative. The multiple is always bounded by 0. So therefore, I can circumvent the problem of that we had originally, which is that we can't find the square root of negative numbers. So therefore, by looking at multiples, we are able to address or short circuit this problem, effectively. So however, the answer that we get will also be a multiple. So in other words, what I am saying is that we can find the geometric mean of the multiple, which we will do in this case as the square root of the first multiple multiplied by the second multiple, that is 2 into 1.5, which is the square root of 3, and the square root of 3 is about 1.73. So that is the geometric mean of the multiple. But how do I get the geometric mean of the returns? Because we want the geometric mean of the returns. We are not interested, our interest is in the geometric mean of the returns. We are looking at multiples only as a way to get to the geometric mean of returns. So how can we get it back? Well, remember that the multiple consists of two components. One is the principal, the other is the return. So if the geometric mean of the multiple is 1.73, then all we have to do is we have to subtract 1 from this, and that will give us the geometric mean of the return, which will be 73%. Okay, so that is how we can calculate the geometric mean of returns. Is it clear? So geometric mean of returns, what we do is we take the multiple and then we find the geometric mean of the multiple, and then we subtract 1 from that to get the geometric mean of the returns. Now this is a compounding scenario, that is we are looking at the money getting compounded over a period of 2 years, and if you see, the geometric mean will be the right mean in this context, because we are talking about CAGR and not the arithmetic mean. So the example that we have been looking at is as follows. We have a 2-year time frame, and we are saying that our stock was at 100 when we started the investment. It became 200 and then 300, and when we calculate the returns, the return here is 100% and the return here is 50%, right? So if we calculate the simple average return, what would that be? That would be nothing but 100% plus 50% divided by 2, that would be 75%. Now a measure of a true mean is that if you put this mean back into the data, then it should square up or it should work fine. What do I mean by that? So let's go back to the earlier example of my 3 students. We have 3 students, as I mentioned, in my class, 80%, 90% and 100%, and we know that their average is simply 80 plus 90 plus 100 divided by 3, that is 90%. How do we know that this is a correct average? Well, for what we can do is, if you add all these 3 numbers, then what happens? You will get 270%, and if you multiply the average by 3, you will also get 270%, right? So therefore these two are equal, so therefore we know that it is a true average. Or another way to think about it is, if you know 2 of the numbers and you know the average, then you can get the third number. So if you know 2 of the numbers and you know the average, you will be able to get the third number. So that is the measure of a true average. So here, how do we check whether the average is true or not? We are having $100 initially. Suppose our return is 75%. If this were a true return, then our $100 should translate to $300 over a 2-year time frame. Let us see if that is true or not. So over the first year, we are going to get 100 into 75% return means it should become 175. Of course, this will not match with 200 because we are dealing with averages. And if you multiply this again, that is not just 75, you have to multiply by 1.75 because the principal also we have to take into account. So again, if you multiply this by 1.75, do we get $300? Do we get our ending value or not? And the answer is no, we will not get. If you multiply 175 with 1.75, you will get something like 305 or 306, something like that, which is more than 300. So that means that the arithmetic mean is not a true measure of mean in this context where we are looking at compound average growth rate. So that's what I said in the slide previously, right? Remember, if you go back here, it may not be a true measure. For example, when we are talking about compound average might be more appropriate, right, in those kinds of situations. So arithmetic may not capture the true rate of return, and I have shown the proof for that in this calculation. So if you use arithmetic mean, then we are overestimating. It's higher than the actual mean. But if you use geometric mean, we can see that it will be a true measure. We calculated the geometric mean as 73%. So suppose we enter that. So then our $100 multiplied by 1.73 will become 173, and again you multiply by 1.73, you will get exactly 300 other than rounding errors, right? You will get exactly 300. So this is using geometric mean, this is using arithmetic mean, and we can see that arithmetic mean is not a true measure, but the geometric mean is indeed a true measure. So that is a proof for what I have stated earlier. Okay. So we have discussed about so far about how to calculate the return. We have talked about how to calculate the geometric mean, how to calculate the arithmetic mean, right? And I have shown you using the data set from the NSE index. We had downloaded, so let me go back there. And I have shown you how to calculate the simple return. So from this simple return, we can calculate the arithmetic mean. Okay, so we can calculate the arithmetic mean. How do you do that? So the arithmetic mean calculation is very simple. We have average. We have a function in Excel called average, and I just type equal to, and then I say average, right? And then I give the numbers. So I go up here and all the way down, and then close the bracket, and so that will give me my average return over the last 3 months for Tata Motors. This is the average daily return. Okay. And then if you want the geometric mean, you can also calculate the geometric mean, and the geometric mean return would be simply, but remember the geometric mean of the returns is meaningless. If you try to calculate the geometric mean of the returns themselves, which we can try and do, you will see that you will get a meaningless answer because of the reason that we just discussed. You can see that some of these returns are negative, some are positive. So if you try to do, it will say, I don't understand, I can't calculate, right? It's giving an error. So what do we do? Well, what we do is we calculate the multiples, which I have done here. This is another column where I have calculated the multiples. And how do you calculate the multiples? We simply add 1 to the returns. So by adding 1 to the returns, we get the multiple. And now if you scan through this column, there will be no negative numbers, which was our intention, which was our objective. We want to get rid of these negative numbers. The minus 7.27%, when we add 100% to that, it becomes 92.73 and so on. So there are no negative numbers, and we can find the geometric mean of this. This is the geometric mean of the multiples. Geometric mean of the multiples, and from this geometric mean of the multiples, we can find the geometric mean of the returns. So geometric mean of the returns we can find. So the first one is actually the geometric mean of the multiples. And so the geometric mean of the returns would be simply nothing but the geometric mean of the multiples minus 1. So if you take this and subtract 1 from that, then you will get the geometric mean of the returns, which is 0.35%. So you can see that the arithmetic mean turned out to be 0.39%, right? Let's highlight this maybe in a different color, green. And then the geometric mean turns out to be 0.35%. They are close. They are low because these are daily returns. These are daily returns. Okay. So 0.39% and 0.35%. You will notice that the arithmetic mean is higher than the geometric mean. And this is always the case. Always the geometric mean is lower than the arithmetic mean, and this is known as Jensen's inequality. Okay. That is something that you may have studied in statistics. I am only mentioning it here because it has come up. Otherwise, it is not necessary within this course to know that this is referred to as Jensen's inequality. But just for your information, Jensen's inequality states that the arithmetic mean will always be greater than or equal to the geometric mean. There is a possibility at some time it can be equal to. If you are interested, review your statistics and you will see what is the condition, the necessary condition for the equality. It is when there is no variability in the data. If all the returns are the same, then the arithmetic mean and the geometric mean will be equal. Otherwise, normally that won't be the case. Otherwise, what we see is that the geometric mean will always be less than the arithmetic mean, as in this example. Okay, so we have seen how to do all these calculations, and in the next segment, we will start talking about risk, and we will continue the discussion forward. So thank you very much, and I'll catch you in the next segment. Bye.